Hey everyone, welcome back to Research Investment. I'm your equity research analyst. Today we're going to explore a topic that's crucial for anyone serious about crypto and macro investing. Why Bitcoin is increasingly seen as a secure investment because of its deep connection with the global M2 money supply. If you want to understand not just the price charts, but the economic forces driving Bitcoin's growth, you're in the right place. Let me walk you through this. First, let's start by explaining what M2 money supply really means. M2 is a broad measure of the total money circulating in an economy, plus liquid assets that can be quickly converted into cash. It includes physical cash, checking and savings accounts, money market funds, and some short-term deposits. Why does this matter? Because M2 reflects how much liquidity is available in the financial system. When central banks increase M2, they pump more money into the economy through tools like lowering interest rates or buying government bonds. This is often called quantitative easing or loose monetary policy. This injection of liquidity means investors and consumers have more cash to spend or invest. Historically, this has led to rising prices in stocks, real estate, and sometimes commodities. But what about Bitcoin? Here's where the story gets fascinating. According to research by Sarson Funds and insights from academic studies at Jönköping University, Bitcoin's price trends show a strong, statistically significant correlation with changes in the global M2 money supply. Put simply, when the money supply grows, Bitcoin tends to rise in value, usually with a lag of about 8 to 12 weeks. This delay happens because monetary policy actions take time to work through the economy, influencing investment behavior and asset reallocations. Why does increased liquidity boost Bitcoin? It's largely because Bitcoin offers a unique form of scarcity. Unlike fiat currencies, which governments can print endlessly, Bitcoin is capped at 21 million coins by its underlying code. This fixed supply means Bitcoin can't be devalued through inflation the way traditional money can. When central banks expand the money supply, it tends to reduce the purchasing power of paper currencies, a phenomenon we know as inflation. Investors, especially those versed in macroeconomics, seek out assets that can protect their wealth from this erosion. Bitcoin, sometimes called digital gold, is gaining broader recognition as a hedge against inflation. And as the US Federal Reserve or European Central Bank pump liquidity into markets, demand for Bitcoin surges because more investors look for alternative stores of value that aren't subject to the same inflationary pressures. The data backs this up. Bitcoin Counterflow and other analysts have mapped global M2 growth alongside Bitcoin's price movements over the last decade. They show clear patterns. During major monetary expansions, like post-2016 and post-COVID stimulus phases, Bitcoin entered prolonged bull markets, sometimes rising thousands of %. After stimulus slowed and monetary tightening began, Bitcoin often faced corrections or consolidations, mirroring liquidity tightening. This isn't a coincidence. It's a reflection of Bitcoin's evolving role as a macro asset. To break it down further, let's look at some specific examples. Between 2016 and 2017, global M2 saw steady expansion as economies recovered post-financial crisis. Bitcoin's price soared from a few $100s to nearly $20,000 by the end of 2017. More recently, in 2020 and 2021, massive money printing during the pandemic stimulus led to unprecedented M2 growth. Bitcoin again followed suit, climbing to nearly $70,000 at its peak. These examples reinforce the idea that Bitcoin's price is intertwined with monetary liquidity cycles. But Bitcoin isn't just about inflation hedging, it also benefits from a liquidity-driven demand effect. More money supply means investors have more capital to allocate. They often diversify into alternative assets like Bitcoin for its digital scarcity and high returns compared to low-yield traditional assets. This makes Bitcoin attractive not only as a store of value, but also as a speculative asset when liquidity is abundant. Now, it's important to consider that this correlation isn't perfect or constant. As the Jönköping University study points out, short-term market factors like regulatory news, technology updates, or macro shocks can cause deviations. For instance, recent liquidity adjustments by the US Treasury temporarily slowed Bitcoin's price despite continued M2 growth. So while the macro trend is there, investors must be cautious and incorporate other factors when making decisions. From my perspective, the main takeaway here is that Bitcoin's link to the M2 money supply elevates its status from just another volatile crypto to a strategic asset. It's part of a new class of macro assets shaped by monetary policies and inflation expectations. This is why institutional investors, hedge funds, and even pension funds have been steadily allocating to Bitcoin in recent years. They recognize it as a unique hedging instrument for a world awash with liquidity. Understanding this helps answer why Bitcoin is considered a secure investment despite its volatility. Its value proposition is supported by underlying monetary realities, not just hype or speculation. If central banks continue with expansive monetary policies, Bitcoin's scarcity and liquidity-driven demand make it well positioned to preserve and grow purchasing power. Of course, Bitcoin still carries risks, regulatory uncertainty, technological challenges, and market sentiment swings. No investment is completely risk-free, but knowing how Bitcoin aligns with global monetary cycles reduces guesswork and anchors your investment thesis in data. To summarize, Bitcoin's price historically correlates with global M2 money supply growth, reflecting how liquidity conditions drive demand for scarce digital assets. This makes Bitcoin a rational hedge against inflation and currency debasement as central banks expand their balance sheets. Its role in portfolios is becoming clearer as a diversifier and protector of purchasing power in today's monetary environment. Now that we've unpacked why Bitcoin's price movement aligns closely with the global M2 money supply, framing Bitcoin as a secure investment linked to liquidity cycles and inflation hedging, let's shift focus to other major players in the crypto space like Ethereum and a few notable altcoins. Their investment drivers are different but equally fascinating, and understanding these can help diversify your crypto portfolio intelligently. Unlike Bitcoin, which is fundamentally a scarce digital asset, Ethereum offers something unique: programmable blockchain infrastructure that supports decentralized applications, smart contracts, and innovation in fields like decentralized finance, DeFi, and non-fungible tokens, NFTs. So while Bitcoin acts as digital gold, Ethereum often earns the nickname digital oil, powering the vast decentralized ecosystem built on its network. One key factor shaping Ethereum's value is network utility and adoption rather than monetary supply metrics like M2. The more developers, users, and businesses build and interact with decentralized apps on Ethereum, the greater the demand for ETH, the native token, to pay transaction fees, reward validators, and participate in staking. Recent upgrades transforming Ethereum from proof of work to proof of stake consensus, notably Ethereum 2.0, have further solidified ETH's long-term investment thesis by reducing energy consumption and enabling scalability. Many investors see this as a form of digital dividend, since staking rewards and network demand create potential for ETH to act as an income-generating asset. The critical point here is Ethereum represents active utility-driven demand. backed by real-world use cases in finance, gaming, supply chain, and more. This is very different from Bitcoin's scarcity-driven value tied to monetary inflation. Moving beyond Bitcoin and Ethereum, the broader altcoin market follows even more diverse investment logics. Some projects prioritize privacy and security, like Monero or Zcash, catering to users valuing anonymity. Others focus on interoperability, such as Polkadot or Cosmos, enabling different blockchains to communicate seamlessly. There are also DeFi tokens that provide decentralized lending, borrowing, or yield farming opportunities, delivering potential returns based on network growth and activity volumes rather than just fixed supply or monetary policy trends. What ties all these cryptocurrencies together is their convergence on two core investment themes: technology and innovation. How well the blockchain or token solves real problems, attracts developers, and grows its ecosystem. Economic incentives, how network economics, rewards, token burning, staking, or transaction fees align investor interests with long-term project success. Understanding these drivers helps investors allocate capital according to not just hype or price momentum, but sound fundamentals. In my perspective, building a secure crypto portfolio today means blending Bitcoin's macro-driven store of value attributes with Ethereum's vibrant utility growth and selective exposure to promising altcoins innovating in specialized niches. This approach balances inflation protection with participation in emerging decentralized technologies shaping tomorrow's digital economy. So while Bitcoin rides the tides of global liquidity and M2 money supply expansions, Ethereum and others rely more on ecosystem adoption, technological upgrades, and economic incentive models. Both angles reflect distinct but complementary investment opportunities in the crypto space. To wrap up this section, if you're exploring crypto as an investment, it's essential to understand these nuances. Bitcoin offers security against monetary debasement, Ethereum offers programmable utility and growing network effects, and altcoins provide opportunities to tap into innovative blockchain applications. Diversifying across these themes helps reduce risk and maximizes upside potential. If you want me to dive deeper into any specific altcoin projects, staking strategies, or DeFi opportunities in future videos, just drop a comment below. I'll bring you data-backed analysis and research to help make smarter investment decisions. Let's continue to watch how monetary policies worldwide influence Bitcoin, while technological development shapes Ethereum and the wider crypto ecosystem, together forming a dynamic investment frontier worth serious consideration.